This Bitcoin yearly candle is starting to resemble the uneasy calm markets experienced after the dot-com collapse in 2001. If you remember, Bitcoin spent nearly an entire year going nowhere, a roughly $51,000 range top to bottom, with the open and close landing almost on top of each other. When a yearly candle compresses like this, it creates a very specific feeling, not of fear, but of fatigue. And that's exactly why I want to talk about the year 2001. Back then, prices collapsed, confidence evaporated, and many people decided the internet experiment was finished. But while markets lost interest, adoption kept expanding. You can see that contrast clearly in the data. The Nasdaq falling sharply on one side, internet users climbing steadily on the other. So here's the real question. Are we watching crypto move through its dot-com rebuild phase right now, while attention stays fixed on price? Stay with me, because by the end of this video, you'll understand what this candle is actually communicating to us, where capital is really positioning, and what a rational crypto strategy looks like in a market that feels stagnant. So all right, let's start with the candle that causes the most doubt. So let's simplify this. A candle tells you four things: where price opened, where it closed, and how high it traded, how low it traded before settling. And this yearly candle tells a very specific story. Price moved aggressively in both directions, yet ended almost exactly where it began. That is the most psychologically draining outcome possible. Dip buyers feel early. Breakout traders feel trapped. And long-term investors are asking the most dangerous question in markets: was I wrong? And this is when labels start spreading. The cycle is over. Bitcoin peaked. Crypto is finished. That is what you hear. However, here's the reality. A flat yearly close can signal indecision, but it can also signal agreement. It can mean the market has temporarily accepted a price level that both patient capital and large capital are willing to tolerate. When markets reach this state, they stop rewarding predictions and they start rewarding positioning. This is where most people make the worst mistakes. They try to force momentum in a market that is deliberately slowing down. The candle is telling you something important. The market has shifted from emotional reaction to strategic assessment. And that brings us to the next question. Is this consolidation healthy? Or is something more serious happening? When people imagine a crash, they imagine disorder. They imagine the worst: forced liquidations, cascading failures, panic everywhere. That is not, though, what we actually saw. Instead, we saw a sharp weekly withdrawal from crypto investment products. CoinShares data shows roughly $952 million exiting in a single week, primarily from US-based products. Bitcoin and Ethereum led the outflows. But now, let us translate that. Investment products are vehicles like ETFs and funds. They are wrappers that allow traditional investors to gain exposure without directly managing wallets or using exchanges. When capital exits those products, it's often interpreted as a rejection of crypto. I see something different, though. This looks like capital doing what it always does when the rulebook feels unresolved. It steps back, it waits, it preserves optionality. It's wise. Capital seeks efficiency, clarity. When friction increases, flows slow. When clarity returns, flows accelerate quickly. So now we have two facts on the table. The yearly candle reflects hesitation. The US wrapper market reflects regulatory uncertainty. The deciding factor is not price, it's usage. Now let's talk about the adoption that has continued despite the price stalls. This is the part of the dot-com era most people forget. The trade collapsed. The infrastructure expanded. Crypto shows the same divergence. Stablecoins are the clearest signal. They function as digital dollars moving across blockchain settlement layers. And people use them for payments, remittances, trading, payroll, and cross-border transfers. And the scale is no longer theoretical. One report estimates total stablecoin volume across networks at approximately $46 trillion. After filtering out spam and automated activity, the adjusted figure still approaches $9 trillion. That's roughly half of Visa's annual transaction volume. The same dataset places total crypto ETF holdings above $175 billion. So, in plain terms, even when price action looks dull, a substantial amount of value continues to move through crypto-based settlement systems. This is true adoption, and this speaks of the sustainable future for crypto. But now let's ground this in a real example. In Brazil, Gen Z crypto adoption increased 56% year over year. Mercado Bitcoin distributed over $300 million in tokenized fixed income products. And yield-bearing instruments delivered on-chain, functioning much like digital bonds. This matters because it changes the narrative. It changes your perspective. Speculation is cyclical. Infrastructure usage is persistent and speaks of what is to come. And that brings us to the part people overlook entirely: system access and institutional architecture. We see that system access is evolving, even if the price is not. Not for now, anyway. So let's talk about financial systems as they actually operate. Most of modern finance is defined by access, settlement, permissions, who is allowed to connect, and under what conditions. When access rules change, markets adjust, even if charts look dormant. The Federal Reserve has floated the concept of limited scope master accounts, restricted access arrangements that could allow qualified institutions to connect to Fed payment systems without a full traditional banking relationship. This may sound technical, but it signals that policymakers are actively considering how new payment models integrate into existing settlement frameworks. That discussion moved into a formal public comment phase, drawing significant institutional feedback. For years, crypto existed outside the regulatory perimeter, but now policymakers are debating how it fits inside it. And this transition phase can be uncomfortable, but it's also necessary. It's like growing, which brings us to the final piece. And that is why the US markets feel heavier than the rest of the world. We know markets price uncertainty aggressively. It's very emotional. And in the US, that uncertainty is centered on regulatory jurisdiction. The Clarity Act, which aims to define how the SEC and CFTC divide their oversight of crypto market structure, is scheduled for Senate markup in January this next year, 2026. And at the same time, legacy financial institutions are accelerating tokenization initiatives. Many of these efforts are permissioned, controlled, and institution-centric or based. So you get a split dynamic. That's what we're seeing. Policy debates continue, and technology continues moving forward at the same time. Stablecoins expanded, tokenization assets grow, and global adoption compounds, all while price waits. So here's the takeaway. Markets can stay quiet while structural progress continues. We've seen this pattern before in every major technological transition. Hype fades, attention drifts, but builders keep executing. And those that understand these market cycles stay plugged in, like you, I hope, because you understand it's only in following the news, following what's going on, and trying to connect the dots that allows you to leverage that information and put yourself in position to take advantage of the next pump when you see it coming, because you're plugged in and are connecting the dots. So that's the advantage you get here at my channel once again. And this flat yearly candle doesn't confirm a failure narrative. That's what I want you to take from today's video. It reflects a market waiting for clearer rules and cleaner signals. That's all. And when that clarity arrives, repricing tends to happen quickly because markets must suddenly acknowledge everything that was built during that waiting period. So as we wrap up today's video, here's what matters when we zoom out. Because that yearly Bitcoin candle may feel lifeless, and that's exactly why it's so dangerous. Sideways markets don't break participants through losses. They break them through doubt. They test your patience. They test conviction. And we already know it tests greed, right? And ignorance. Anyway, right now, the underlying story remains active, and that's what's also so important for you to take away from today's video. Remember, capital hesitates and U.S. investment wrappers because regulatory definitions remain unsettled, but that's not going to last forever. And usage, we see, continues expanding because stablecoins and tokenized products already perform real economic functions. And that's the most promising longevity signal and factor for us to remember. And we see system access discussions are advancing because institutions are adapting to new settlement realities because they're better. Web3 technology is the next generation in financial technology in and for the world's infrastructure layer. So it's not going anywhere. The crypto market's not going anywhere. Bitcoin's not going anywhere. So just take that away today. Don't panic, stay steady, stay plugged in because this thing is going to take off. I still believe we're going to see a super cycle bull run. And I believe it goes on into like the future for many reasons. Let me know if you want me to cover this whole discussion you may have heard out there about this whole AI bubble and what it means and how we're going into a recession and all these things, because I believe we're not. I believe the US cannot afford to let the economy fail because it's an arms race right now to be the leader in crypto, in Bitcoin, and in AI. And that requires a ton of money. So what do you think the government is going to do? Do you think they're going to belly flop and not continue to fund these industries that literally are a matter of national security and also who becomes boss on this planet for the next 100 years? So I don't think the crypto market's going anywhere. I don't think Bitcoin's going anywhere. I don't think AI is going anywhere. I think all of these markets are going to boom in the next couple years and into the future, frankly. So let me know if you want me to do a deep dive on that. I'd be happy to. But anyway, the point is that right now, what we're seeing looks like a post-hype build phase. It's quiet, it's uncomfortable, yes. It's very easy to dismiss, but I hope you don't. Because historically, this is when foundations are reinforced while attention fades, while everyone with a short attention span is distracted. I hope you are not. I hope you stay plugged in and focused on the goal. So as we close out today's video, here's the question to keep in mind. When regulatory clarity finally arrives, because it will markets be positioned for what already exists, or will they be forced to reprice it all at once? And if and when they do, what do you think will happen? So if this video today helped you see the broader framework, the bigger picture, just like the video, subscribe if you haven't yet. It means so much to me. And share the video with a friend or a family member who needs to know what's going on. That probably means even more to me. I love you guys so much, and please leave me a comment on what you thought or what questions you had about today's video and what topics you'd like me to cover in upcoming videos. I will be producing less content throughout the holidays, and I will not be sharing a video tomorrow, just FYI, because it is the holidays. So let me know what you'd like me to cover in Wednesday's video, and I'll be sure to take that into consideration, and I'll see you guys here on Wednesday, okay? Take care.